Okay, welcome to Milestone Investing, secure, rapid wealth building investment system. And it's known as the dividend fishing strategy. Now, this is something I learned. By the way, my name is Miles Thomas, and I spent maybe a number of years in America actually studying and learning about investing. And I'm going to tell you a quick story about the dividend fishing strategy. This was one of maybe 20 strategies I learned. So it's one of 20. And but this one came with a story. And here's a story. It was in the late 1980s, I believe it was. Two or three Japanese bankers went to America with £1 million. I'm sorry, $1 million. And they started to trade in the American stock market, and they were basically investing in dividends. Dividends is the money that companies and corporations pay their shareholders for being shareholders. Anyway, they were trading dividends, or trading for dividends specifically. And I think it's about 2 years later, they left America with $11 million. Now, when I heard that story, I thought, that's a good rate of return. Let me pay attention and find out how this one works. Now, I'm going to be honest with you so that there's no one under any illusions here. This is not a get rich quick scheme. So if that's what you're looking for, this is not the call for you, number one. And number two, a lot of investment strategies, so-called investment trading strategies, is really gambling. You're guessing what the stock market is going to do. You don't know what it's going to do, but you're guessing. And if you guess right, you do well. And if you guess wrong, you lose money. A lot of it is gambling. And so if you understand what you're looking at and where the value of the thing you're looking at comes from, then you can start to make an assessment as to whether or not this is for you or not for you. And if you have a high tolerance for risk, then obviously those people can do those strategies that are linked with that. But if you have a low tolerance for risk, then really you should avoid all the gambling type investment strategies, if you want to call it that. But there are a lot of them, and hopefully I can give you some understanding so that you can actually start to see where you need to be educated if this area of lack of understanding for you. Okay, let's get started. Today, I want to go over some very, very basic fundamentals, but this grounding is what's going to make life easy for you going forward. So, first of all, I want to give you what I call the poverty formula. Now, a lot of people know this one because they know someone quite intimately who follows it. So let me tell you what it is. The poverty formula is when you earn less money than the cost of your lifestyle, and then you borrow the difference to make up the funding gap. Now, the way you would do it is most people would do it on a credit card. Now, if they do this consistently enough, they will get into problems going down the road. Now, there is a certain personality type that will always follow this pattern. And it's nothing to do with them being silly or ignorant or not educated. It's nothing to do with that. It's there's a psychological pattern that some people who have this model in their minds and the way their brain works, they will fall into this trap. And it's basically they're responding to their emotions. That's really what's going on. So they've got the psycho-emotional response to external stimuli, and they're the ones who fall into this trap. And unless they are aware of what they're doing, it's not easy for them to break out of it. But once you're aware, that's me, for example, and then you can say, okay, so my patterns was going to lead me 20, 30 years down the road having nothing, then you can take some action early on. And there are strategies you can do if that happens to be you and your personality psychological profile. But a lot of people earn less money than their lifestyle, and they borrow the difference. Now, you might argue, okay, well, I know the secret, just earn more money. But according to Dave Ramsey, he says that unless you control your spending, making more money won't help you, because all you're going to do is end up with bigger payments. And this is the problem with earning more money. You just have bigger bills. And I'm going to tell you a quick story. Many moons ago, when I was a young accountant, I got a promotion that it basically had me double my salary. Okay. And very soon afterwards, a friend of mine came to my house and he was basically showing me his brand new sports car. And it was absolutely beautiful. And looked at it, and he's kind of a little bit showing off as well. But we were young at the time. We were young, and at the time I was also, but I had different circumstances to him because I was a young man with a family. So when I was about maybe 25 at the time, I had a family, and this man was a single person. So him having a two-seater sports car was appropriate maybe for him, but it wasn't for myself because I had a different family circumstances. What was interesting is that when he left, I remember saying to my missus that's it, I'm going to buy myself a two-seater Mercedes Sports. And she goes, why? Where are you going to put me and the kids? And I thought, well, I'll get you another car separate. And she goes, but hang on, stop. Before that man came to the house, you did not need a two-seater Sports Mercedes. Why do you need one now? And she stopped me in my tracks. And I thought, you're right. Before my friend turned up my house, I didn't need a car. I didn't need that car. Why do I need it now? And I realized that what happened was that my competitive nature, let's say, and plus my ego was, maybe, I don't know, stimulated by him showing off. And I wanted to say, well, you can do it, well, so can I. And that's what kicked in. And it wasn't until someone basically had me wake up and say, actually, you're responding to the wrong stimuli, and this is not appropriate for you in your circumstances. That's when I said, I'm not going to do that. And I basically changed my desire for the car. So all of a sudden, that car I bought in my mind came off my shopping list. And it was that simple. And I was basically being, all I wanted to do, you know what it was? I was trying to keep up with the Joneses. It was simple as that. And I didn't like the fact that my friend was showing off and saying how great he was. And the truth is, nothing wrong with that. But my competitive streak, I'm quite competitive, but my competitive streak kicked in, and I wanted to say, well, I can do it too. And so, if you are young and that's your nature, you need to have strategies in place to protect you from yourself. Okay. Remember, I told you a lot of it is psychology. A lot of it is psychology here. But going back to this statement, unless you control your spending, making money won't help with the poverty formula, because you just end up getting bigger bills, you get a bigger house, you get a bigger car, you get a bigger and everything else, and all of a sudden you're back to basically being either just about coping or going back under again, requiring credit cards to keep you afloat. Now, I used to work for a number of hospital organizations in England, so I became very familiar with government financing model. And I'm going to tell you straight up, the government follows this model. They spend more money than they earn. And they're always in deficit. Some people call it deficit spending, and this is what they do. And it's not as true for the British government, it's true for governments all over the world. All governments have this pattern, and so they're effectively broke. Now, the only people who get served by that, let's say, irresponsible spending patterns, is bankers, because bankers lend them the money and bankers make money on interest from this whole process. And so I can understand why it would appear that governments are, I just think to myself, how is it possible that these guys don't know what they're doing? They're intelligent people. I used to work there, so I know that the accountants there are smart people. They're not stupid. Why are they doing this? And there are some systems in place. It's a systemic problem. That's what I'm going to say. And it feeds bankers to lend money to governments. Make it very, very simple. And it's in place for that reason. People in government only are in place or are in position for maybe 4 years, 5 years, and then they move on. That's the nature of politicians. When they take control and become the prime minister, and they become the controlling entity within the country, and they obviously want to get their agenda funded, for example. And because they're only there for a short period of time, they don't have this 20-year, 30-year time horizon and goal in mind. They don't have it. They have a very short-term goal. And because of that short-term mechanism, nature of that particular set of individuals, let's say, they don't think long-term. And it's true for nearly every government. The only exceptions would be where you have maybe a monarch and he creates a sovereign fund, and then maybe they would have a different approach. But everybody else, they're all short-term thinkers, and it's short-term thinking that causes the problem. Let me talk about the wealth formula, because let's forget about poverty. We don't really want to play with that one too much. The wealth formula is this: earn more than the cost of your lifestyle. And the difference, you invest it in income producing, appreciating assets. Income producing, appreciating assets. So let me give you the most obvious example in this category. You buy a house, which is the asset, and over time it will go up in value. And yes, it can go up and down, but over long term it goes up in value. That's number one. So it's appreciate. Oh, by the way, the word appreciating means going up. And number two, that house, if you rent it out, don't live in it. If you rent it out, it will give you rental income. Buy between 5 and 10 of those over a period of maybe, I don't know, 10 years, let's say, buy one a year, and you rent them out. This will give you, once the mortgage is paid 25 years later, this will give you a free house, because remember, the mortgage was paid by the tenant. This will give you a free house 25 years later, and all the income is yours. Okay? That's an appreciating asset, and you get income from it. Now, this technically is, you could call this your pension, but instead of waiting 40 years to get your pension when you're 60-something, you could do this in the space of 25 years. So instead of waiting 40 years, you kind of, bring it down a bit. And you could technically set yourself up, if you do it early enough, to basically retire young. Okay, I'm not talking about investing in property at all, but I'm just giving you the idea that once you understand what an asset is, the kind of assets you need to have, and also making sure that it generates an income for you, that sets you up basically to do well long term. And you have to think long term, by the way, if you want to do well in this game. So like I said, if you're thinking short term and a get rich quick scheme, this is not for you. I'm talking about people who just want to understand and plan their life better. And especially if you've got children, give this information to your children when they are young, because by the time they come out of university and they go into the workplace, they will start to adopt good habits. I want to talk to you about something called compounding. Now, compounding is one of the absolute must pillars you must have. So if you learn nothing at all today, please make sure you learn this. And Mr. Albert Einstein, no less, said that compounding is the most powerful force in the universe. The most powerful force in the universe. Just for this, I would like someone to, if they can, to help me out. So I want to do a demonstration here. Let me see. Let me pick on someone. I was talking to a lady called Lynn. I'm gonna hopefully, Lynn, hope you don't mind me embarrassing you. I won't embarrass you at all. But I just want to wonder if you can help me with something. Lynn, I've just unmuted you. All right, Lynn. Yeah. Right, relax. I'm not going to put you under too much pressure. Okay. Okay. So what I'd like to do, Lynn, is I want you to imagine that a very wealthy person decides that they're going to invest some time educating you on investing. Let's say that, right? Sure. And what they do, they say to you, okay, I would like you to start with £1,000. Mm-hmm. And what we're going to do is, over a period of 1 year, we're going to do a range of things, and it's going to have the impact of making that money double. Sure. Yeah? If that was the case, how much money would you have after year 1? At the end of year 1, you start with 1,000, you double the money. How much do you have at the end of year 1?
If you just double it?
Yep.
£2,000.
Fantastic. So that's years. I'm counting beginning of the period as year 0. So you got 1,000. You then, at the end of year 1, you've now got 2,000. Okay. Imagine you do the same thing again. In year 2, you double it again. How much do you have?
4,000.
And again, you do the same thing again. How much do you have?
8.
Same again. How much do you have?
16.
Same again. How much do you have?
32.
32, correct. Same again. How much do you have?
64.
Same again. How much do you have?
$128.
Perfect. If you're getting stuck, I'm going to show you a very quick and easy way to double it just by looking at the numbers in front of you. But if you can do it yourself, it's okay. If you double this again, how much do you have?
Two five 256,000.
Perfect. And double it again, how much do you have?
512.
Perfect. 512. Perfect. And one more time. If you double this again, how much do you have?
Shit. Well, it's definitely over a million. Yeah, it's over a million. I can't. 1,024,000.
Absolutely correct. 1,024,000. So, well done. And by the way, I do apologize for making you sweat because I know you didn't come here to do that work. but thank you very much for your help.
Thank you.
Okay, so with Lynn's help, what we just demonstrated that if you was to take a sum of money and double it every single year, you just double the baseline starting point every year, £1,000 becomes £1 million 10 years later. Here's a simple question, and answer this for yourself. If you could be shown anything, it doesn't matter what the investment model is, if you could be shown anything that could do that, would you start it, knowing that that would happen over time? And here's the thing, and let's say, for example, it took you maybe 15 years to get that result because maybe you messed up in the early years because obviously lack of competence means you make mistakes. So let's say in the early years you made a few mistakes and it took you maybe 4 years to kind of get your head around what was really going on. And so 4 years later, you was really now doing year zero. And so therefore 15 years later you get here. Would it still be worth it? That's only a question that you can answer for yourself. But if you've answered yes, then you might be saying, but hang on, Arthur Miles, you can't put your money in the bank and get that kind of return. And the answer is you're absolutely correct. But the reason why I demonstrate this to you, because this is the power of compounding. Now, I won't show you the compound growth formula because it's just not really appropriate for this conversation. But here's one thing that the bankers know. The bankers know this. The bankers are doing this. And that's how banking organizations become wealthy. They are doing this compounding. I'm going to tell you something else. All the billionaires do this. Maybe not millionaires, but billionaires, they are doing this. I, a long time ago, had the very good fortune to be involved with some film financiers when I was doing some film financing back in the day. And one of the people who was associated with what we were doing was an Indian man called Lakshmi Mittal. Now, Lakshmi Mittal is one of the richest guys in England, actually, one of the richest Asian guys in England. And he runs a steel business. But one of his side projects, remember he does this, but one of his side projects, he actually invests in films, especially in the Bollywood world. He invests in TV production and in films. Most people don't know this, but that's what he does on the side. But what's interesting is that when we spoke to their accountant, who was the one who manages their investment, his investment portfolio, he told us if you want to actually bring a project to him that's going to get his attention, you need to follow certain rules. And he basically laid out what we needed to do to basically get an audience with this young man. But the point I'm trying to make is that he does this. Not only does he do this, all the other billionaires, either their advisors are helping them or they're savvy themselves and they're doing this. And this is something you must know if you actually want to break out of poverty. So the first thing you must do, you must create a reserve between what you earn and what you spend. Create a gap. And that gap, start to invest it in things that you understand. Now remember the key things, you must understand what you're doing. Don't gamble, don't do things you don't understand. Learn about something and do that. But make sure it follows this rule. and it follows the rule of compounding, then you're onto something. And even if it compounds at a rate of 50% or 20%, it doesn't matter. As long as you do compounding, you'll get there. There is a man called Warren Buffett. He has a compounding growth model of 20%. So it'll take him more than 10 years to become a billionaire. But he's a billionaire now. And he started in the 1950s, I believe. And he is one of the richest men in the world because he follows this rule. So if you learn nothing today, recognize that. Make sure you understand compounding. And if you're going to invest in something or you're going to grow your assets in some way, make sure you follow something similar to this, okay? Even if it's 10% a month or 10% a year, 20% a year, 50% a year, it doesn't really matter. Make sure it's compounding. That's a key ingredient. Okay, so let's do a reality check because these are highfalutin numbers, right? So let's do a reality check. Where can we find investment opportunities in the real world that have the potential to deliver on that promise? Now, this is where I'll be honest with you, you cannot go to a financial advisor and say to him, I heard about the doubling money effect. I want you to put me in that program, please. Because this doesn't really work unless you are in the driving seat. If you're in the driving seat of the investment project, this works. But if you're not in the driving seat and you don't have specialist knowledge, then it's going to be a little bit tough. Okay, so, but you have to be in the driving seat. And if you are in the driving seat and you're savvy and you make sure that you don't spend everything you have, this can be a possibility for you. Okay, so I'm going to show you now a way that so many people, by the way, this is actually, even though everybody knows this, on a surface level, there are some secret hidden stuff I'm going to show you today that is how a lot of people do what I just said earlier, how they compound their money over time. Okay, and so I'm going to show you something, but just to make sure that I'm not just speaking from a theoretical base, I'm going to read an article that comes from City AM. Now, City AM is a newspaper that comes out every morning, and depending on where you live, you'll find it near the tube stations. And what they do, they only talk about financial stuff, mostly financial, maybe some government issue stuff, and then at the back page you might get some sports stuff, but in the front pages it's all business. Okay, and in December 2016, the headline was FTSE 100 companies are expected to shell out nearly 80 billion in dividend payments next year. 80 billion pounds was given away by the equivalent of, so let me tell you how this works. Tesco will sell you baked beans and sell cornflakes. They will make a profit on the back of Tesco of selling baked beans and cornflakes, okay? The profit they make, they divide it into two portions. Portion number one, they give away to their shareholders. And portion number two, they keep for themselves to grow their business. We are interested in portion number one. How do we qualify for the money that Tesco will give to their shareholders? How do we qualify for the money that Barclays Bank will give to their shareholders? How do we qualify for the money that Morrison's, that Legal & General will give to their shareholders? How do we qualify for that money? And this is what I'm going to be talking to you now about, because it's this strategy that allows you to take advantage of the compound growth formula we spoke about earlier, okay, in a way that is not just pure gambling, okay? And so if Tesco say they're going to pay you dividends, they're going to pay you dividends, end of story. They're paying it to you, all right? And I'm going to tell you from my experience of being a landlord, I prefer Tesco to feed me than have a tenant feed me, because very rarely will Tesco say to me, sorry, mate, I lost my job. I can't really pay you this much money. Then I have to take it to court and I don't have those hassle. If Tesco say they're going to pay, they're going to pay. Now, I shouldn't have diverted there, but I'm just really saying to you that this is something that pension funds put money into. They look for this. The big hedge funds do this. So I'm going to share with you a secret that those big guys are playing with, and you're going to know it to yourself when we're done today. All right? So what I'm going to take you to is a newsletter that is provided by Milestone Investing. And what they focus on is companies that pay dividends. We don't speculate on the share price, whether it's going to go up or down by 20p, or not interested in that. We're interested in qualifying for dividends. Okay, so it's the equivalent of me buying a house so I can get the rent. And even if the house price doesn't move in by value, I don't care. I want the rent. I want the rental income. Okay. Let me just give you an example of what you would find in such a newsletter. I'm taking an extract from the newsletter. So on the 9th of March 2017, last year, a company called BHP Billiton, which is a mining company, by the way. BHP Billiton, and they're a multinational mining company. They have mines all over the world. They said that they were going to pay a dividend. If you look in the fifth column along, they're going to pay a dividend of equivalent to 2.4%. And if you go to the third column, the dividend was actually 32p. And the price at the time was roughly 1,362p. Now, when it comes to expressing share prices, they don't say £13.62, they say 1,362p. Everything here is expressed as pence. Okay, so 1,362p, £13. But they said they were going to pay a 32p dividend, and to get that dividend, you had to buy the share at about £13. If you take a calculator and you say 32p divided by £13 times 100, you get 2.4. Now, here is the secret. I'm going to tell you two secrets. Secret number one. There is a way to buy those shares or qualify for the dividends, but only have to pay the deposit, not the full amount. So imagine buying a house, and instead of me paying the full, and let's pretend the house is 100,000, just to keep the numbers simple. Imagine I wanted to buy a house for 100,000. I've got two choices. I can shell out 100 grand, or I can put down a deposit and ask the bank to fund the difference. So let's say, in example, I put down a 5 grand deposit and I get 95,000 from the mortgage, from the bank. I then rent the property out. The tenant pays the rent pays the mortgage, and I collect the benefits of the property. And all I had to do is put down my deposit. Well, the figure on the left, that says margins. That says that you could have bought this company's asset for 5% deposit. Margin means deposit. And if that's the case, instead of me getting a return on investment of 2.4, that, because I'm only putting down a fraction of the money, that would actually equate to a return on investment of 47%. 47%. Okay? And so on the right-hand side, it's really telling you that's how that works. Now, just in case some of you are a bit more technical and you think, well, hang on, but where did I get the loan from to do all of that? I want to bring you into the mind of a model that works for this one. And here's how it works. In America, there are some people who will sell you a property and they'll sell the house with finance. What does that mean? The person selling you the house will give you the mortgage, not the bank give you the mortgage. The person who owns the house, they will sell the house with a mortgage. This works in America for those people who really can't get a mortgage because their credit is rubbish. So what the owner would do, they would actually basically sell you the house, and they say, right, instead of giving me the whole 100,000, you're going to pay me every month the equivalent of that money plus over a period of 20 years or whatever the period is. And so you could actually pay the previous owner the money. In England, that's unheard of, by the way. But in America, it's, I wouldn't say standard practice, but it's one of the ways people can buy property in America. And I learned this when I was there doing property investing, etc. And this is called seller financing. Seller financing. The seller sells you the house complete with the package, and then there is a mortgage with the property. So you basically move in, and it's like you're paying a rent, but 20 years later the house is yours. That's the difference. Anyway, cut a long story short, this comes with seller financing. So instead of you having to worry where you get the money from, just put the 5% down. This instrument comes with seller financing, and so therefore you can pick up the whole dividend of 32p for a fraction of the cost. And if you take 5% of £13, you're paying roughly 68 pence. Yeah? And so you pay 68p to receive 32p. And that's basically how it jumps up to 47%. So let's look at that top one and see what happened. Now, this was on the 9th of March 2017. 1 week later, the next newsletter comes out, and it says this. It said, for those investors who, now there's some vocabulary here which I'm going to have to explain, but I'm going to keep it very brief. When you go long, which is the numbers in red, when you go long, it means that you buy something, and when the price goes up, you make money. And when you go short, it means that when the price goes down, you make money. It's reversed. So if somebody was to go long on a stock and the house price went from 100 to 200, 300, they're making money. However, in the stock market, if the price falls, you can also make money. And that's what they call going short. So that's very simple there. So in this particular case, this company, within 1 week, had you gone long, the red numbers, you would have made 47.3%. Okay? At the worst price, by the way, at the worst price. And had you gone short, you would have made anywhere between 53 and 56%. Now, the short trading is a bit more advanced, so I'm not even going to look at that. I'm just going to show you the red numbers only. So you might say, but come on, Miles, prove it to me. You know, it's easy to have a little spreadsheet and do these numbers. So I'm going to actually show you the chart itself. And let me see if I can, I'm going to get a marker pen so you can see what I'm looking at. There we go. So this is a chart, and what you're looking at, those red and the green things at the top are called candlesticks. All right, and each candlestick represents 1 day, and the day to qualify for the shares was here. And this is secret number 2. You don't have to own the shares for a year or for a week or for a month. You need to own the shares on this day, and this is called the qualification date. If you own the shares on this date, the dividends are yours. So here's what happened to the share. The share price dropped because what happened? They shelled out all this money from the company. So if I said to you, can you give me 25 million pounds? The minute you do that, you are poorer by 25 million. No matter how much money you have, you're poor by 25 million. And so their share price dropped because they were poorer. But here is what's really interesting. And by the way, it should have dropped to roughly about the blue line based on the value of that one. So it dropped by too much, okay? And then it went sideways, and then it went up, and went sideways, then it went up, and then it went up. And had you bought it at the worst price, which is the green line represents the highest price it was on the qualification date. This candlestick goes above that, which means you got your money back here. So let's count the days. This would have been a Wednesday. So this was Thursday. This is Friday. This is Monday. This is Tuesday. This is Wednesday. This is Thursday. So basically, you got a 47% return and you got your money back 1 week later. BHP Billiton, mining company, last year. Okay? And that is what a lot of professionals are investing in. They invest in getting the dividends of the company, then they push the price up and take their money. And it's as simple as that. Okay? let me show you another extract from the newsletter, something different. And what this shows is, again, I want you to focus on the column on the left. Sorry about that. If you focus on the column on the left, that one says capital returned within 1 week. You can see the bottom company called Rand Gold Resources. It said 100% of the time in the last 4 years. So here we go. In the last 4 years, right here, historic time frame. In the last 4 years, this company, had you done this strategy, would have given you money back within 1 week, 100% of the time. Okay, and then this over here shows you by how much it falls by the overfalling. And it says here really that it overfell 0% of the time on day 2. So if this was Wednesday when it happened, Thursday, Friday, 0% of the time would you have made money by going short. In other words, it's telling you this, in fact, you know what? This is the closest I know to a guarantee. 100% is a guarantee practically, right? 100% of the time, Rand Gold gave you the dividend and your money back within a week. And this was true for the last 4 years at that time. So let's have a look at that particular chart and see what that looks like. And again, the relevant period for us is this candlestick right here. The green line represents the highest price on that day, and the red line represents the lowest price on that day. Now, had you bought the shares on that day, the very next day, you got your money back because it went above the green line. The very next day. Okay? Now, we tend to only focus on companies that will pay really 20% or more. Anything less than 20%, we don't even look at it. And so, as it's on our radar, clearly this is done well. Now, because it also, not only did it give you back your money, but it gave you excess. It gave you more than your money back. You're going, look how far above the green line it is. So this one gives you your money back and with profit and the dividend. Okay? Now, this is not normal, by the way. So I'm going to tell you straight up, this is not normal. You wouldn't normally have the thing jump up like that and give you this additional bonus. That's not normal. But that's what it did on that particular year. So let me show you one more example. Okay, because I don't want you to think it's only 2 things that happened. So let me give you another example. There's a company called BP, British Petroleum. Now, this company is a massive, massive company, okay? They're as safe as houses, if you want to use that phrase. And in this case, these candlesticks are 1 minute. How do we know? It says so here. The resolution is 1 minute. So each candlestick here is only representing 1 minute. This is the day before, the qualification day. So let's say here, we bought the share at the worst price, highest. It gaps down because they pay the dividends, so they make an adjustment for it, and then it starts to bob along. It bobs along, moving sideways. And then at some point, it starts to go north, bobbing along, north. It keeps rising, 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 and right here, it gives you your money back. And if you look, the very next candlestick, somebody was selling because they got their money back. A red candlestick is a downward pressure, somebody's selling. So someone, as soon as they got their money back on this one, they sold it and got their money back. But what happens? As soon as whoever they were sold out, the share price kept on rising. Okay? And then again, it dropped down. Where it dropped to? To the same place where you need to get out at to get your money back. How long did it take? Well, let's have a look. The stock market opened at 8 o'clock in the morning. 9 o'clock in the morning, it's messing around. 10 o'clock in the morning, it starts to rise. And by about 10:15, right here, you get your money back. So anytime after 10:15, you get your money back. It takes 2 hours to get your money back. Now, this is the Usain Bolt of this strategy. It doesn't take 2 hours normally to get your money back, right? So let me not have you believe this is normal. This is the equivalent of the Usain Bolt. But what I'm trying to share with you is that professional investors know this game and they play this game. And now I'm sharing it with you. Okay. So what is the strategy? What is it you're doing exactly? Well, number one, you buy dividend paying companies on or before the qualification date. Number one. Number two, you receive a dividend and then you sell the company when appropriate at a profit. When appropriate means when it rises back up to the point where you got in at and you get your money back. Okay? And it is that simple. Okay? That's strategy. Now, if you combine that strategy with what we spoke about of compounding earlier on, compounding your money, you've now got a specific strategy that allows you to follow the compound growth formula. Okay? So let's do a summary. What have I spoken about and what have you heard today? We spoke about buying income producing, appreciating assets. We spoke about getting income every week from the top companies in the UK. Now, why do we pick on the top 100 companies? Because they are the safest. We're looking for safety. It's that simple. If you are the top 300, not interested. We want the safest companies in the UK. That's why we pick on them. Yes, there are other companies that you could use as well, but I want safety. And so because I want safety, I'm going for the top 100 only. And number three, we use the power of compounding to grow the investment portfolio exponentially. Now, you saw in the examples where you can make 48% in one week? 1 week. So now you know, and I've shown you real examples, that making 100% in 1 year is doable. Because I've just shown it to you. All right. Now, hopefully you found this quite useful. And for those of you who might want to go forward and actually get some training, because I'm going to say this to you, jumping in the stock market with no understanding and knowledge is not a safe thing to do. It's like jumping in the sea and you can't swim. That's not really a safe thing to do. And so I'm going to suggest to you that you get some training from anywhere, from myself or anywhere else. But make sure you get trained, and then once you know what you're doing, go ahead. But let me tell you what I can offer you. There are a number of things that you must know for this to be something that becomes your skill set. Now, it's not about me taking your money and investing your money. I'm not interested in that. What I'm interested in doing is passing on a skill set so you have the knowledge, so you can do it for yourself. What do you need to know? You need to know fundamental analysis. This is understanding the profit and the growth trends of the companies that you're actually looking at. You need to know that, and we will teach you that. We'll expose you to that. You also need to know technical analysis. This is where you read and understand what the charts are telling you, because there are some times when the charts will tell you, don't touch this company, it's going down. Or it's going to tell you, here's the right time to get in, it's about to go up. If you can read charts, the clues are in the charts. Okay? And if you learn technical analysis, you will begin to understand what those charts are telling you. And number three, these skills are transferable. Once you learn fundamental analysis and technical analysis, and you got grounded properly in that, you can actually transfer this skill, and then you can start trading currencies. You could start trading equities. You could start trading indices. You could even trade cryptocurrency. So, I'm going to just quickly show you an example. Now, by the way, I don't trade cryptocurrency. I don't trade it. But I'm going to show you, even if I don't do it, I know how to do it, okay? Because I've got the relevant skills, and my skills are transferable to any asset class now. So let me just show you Bitcoin as the most famous cryptocurrency out there. This here was a peak point, and if you look along the chart, you can see it was roughly about $19,800 for one Bitcoin. So it's been rising, hits this point, and then hits a ceiling. It bangs on the ceiling and then starts to come down in this channel. It goes up, it comes down this channel. It goes up and it starts to go in a slightly less inclined channel, but it's still going down. Where were the clues that told you get out at the ceiling? Where were the clues? Well, the clues were in something called RSI. RSI, and by the way, if you want to get trained with us, we'll show you how to read this stuff. RSI stands for the Relative Strength Index, okay? And this indicator gave you the clue here. The clue was here. The clue was here before we even got to that peak. The clue was here. Secondly, something called a MACD, which stands for Moving Average Convergence Divergence. The clue was here. Here. Right here. Get out. So RSI told you a few weeks earlier, and MACD confirmed it. Get out. And had you gotten out really slow, imagine you were slow and you got out here. Instead of, throwing away, well, let me just say this. Had you got in at 20 grand, you could have gotten out before it hit 16 grand. So you would have maybe lost $4,000, all right? Had you maybe, but I'm assuming you came in at a low price, hits a peak, and when it gets $16,000, the signal tells you get out of it. You got the clear signal. However, for those who didn't understand that, you could have actually ended up coming out here when it hit 6,000, because it hit $6,000 right here. And then it bounced, okay? And so it went from $20,000 to $6,000 in the space of less than a month. In fact, just over a month. It peaked in mid-December and it hit that low point at the beginning of February. It took nearly a month and a half to lose basically 14 grand. Now, if you are ignorant in the area of cryptocurrency, you would not have seen that coming. And so those of you who do trade this, remember, I don't touch this stuff, but those of you who do trade it, when you learn how to trade properly, you would see this coming and take advantage of it, make money, or you would get out and reserve your capital base. And you must know this stuff, otherwise you are just gambling, okay? All right, let's move on. And what I'm trying to say is that just understanding technical analysis alone would allow you to see what was coming up, okay? And again, we show you how to read this stuff because it keeps you safe. Some more examples. There's a Bitcoin called Ethereum. Again, the clue was right here. The clue was here. Get out. Okay? And another one called Ripple. The clue was here. Get out. And so basically all of them gave you a clue that this thing had basically peaked and it was going to fall. Okay? And so had you known how to trade using technical analysis, you could have gotten out. Now, the reason why I showed you that is just to let you know that this is a transferable skill. Once you know how to read charts, you can read charts for every asset class where they show you and where they trade them on the exchanges. Okay, so what are your next steps? What should you do next? Well, let me tell you some more about what is the results for our guys. We research the best dividend fishing investment opportunities, and then we trade the best ones every week. Our subscribers typically make anywhere between 120 pounds a week and 36,000 pounds a week. And you're hearing numbers correctly. I'm not making this up. Some people earn over 30 grand a week. Okay, and some people earn about 120 pounds a week. Now remember, if you're compounding, this will grow over time. So remember, if you're trying to do this in a hurry, this is not for you. But if you learn the skills and take your time and grow it, this becomes a possibility. You can purchase the research from an experienced supplier, and it will save you time and it will save you money because you don't need to make your own mistakes. Okay. And if you're inexperienced and you've never traded before, we teach you at no extra cost how to trade. And if you do this, you will learn a life skill where you could earn while you learn. So, in essence, what Milestone Investing does for you is we do the research so that you don't have to do it yourself. Okay? But what you must do we're doing the research for you. But what you must do, we want you to understand what you're doing. We don't just say we'll do it for you, nothing of the sort, because we want you to teach your children, to be blunt. We want you to teach this to your family, so therefore you can actually help them to get away from bad habits that really won't help you. And if you go back to the original poverty formula, you know what I'm talking about. All right. So you're asking yourself, what is the value of this training? So let me tell you what the value is. Now, what we do, we will do 1 day online training. That's valued at £500, sorry. We will give you a weekly newsletter with all the information researched for you. And all you got to do is just read it. We value that at £50 each newsletter. Okay. And we also do a conference call, very similar to this, where the first part is talking to you what's going on in the market and which is the best ones which companies we think is the best ones to go for. Now remember, we're not giving you, we're not saying that we know everything, because we don't. But what we are saying is that we're looking at a company and we're saying, right, over the last 5 years, how do you trade this over the last 5 years? What would have been the results? And we show you what would have happened had you done this. How do you say, let's say Tesco, pick on Tesco for a second. How do you pick on Tesco? What would have happened in the last 5 years? How do you traded this? Would you have done well or not? And we show you, all right? So therefore you can see it for yourself. And that takes place every week. And we only focus on the companies that are coming up, obviously, that week. And again, that's valued at £50. And if you add it all up, you've got a total value of £5,700. It's basically, and this, by the way, is for 1 year. So you're going to be supported for 1 whole year. All right. But we're not going to sell it to you for 5,400. We're not even going to sell it to you for 3,700, and not even 2,700. So you're saying, come on, Miles, put me out of my misery. What are you actually saying? Here we go. For £1,500 total investment, which is equivalent to £30 a week, you can subscribe to our newsletter for 1 year, and that 1 year subscription includes training for those of you who don't know how to trade. Okay, and that's basically the offer, and that's what we do for everybody. Now here's the thing, we have a training course coming up in 2 Sundays time, and for those of you who are ready and want to go ahead, we're going to do a special offer for you. But it can only last, obviously, for 9 days, because of the fact that the training course will be in 2 Sundays from now, it'll be over. And so if you want to go on that one, we're going to do this for you. But it's a 9-day offer only, obviously, because the course happens then. So for 9-day offer only, if you basically pay the full amount, which is equivalent to £19.96, then basically, and you can basically start learning in 2 weeks from now, and just get going, and we'll basically work with you for a year. And every week we'll be talking with you and get you through your paces. I will say this to you: if you're completely green and can barely count beyond 10 fingers, most people I know who are in that situation, within a year, they know what they're doing. In fact, I don't know anybody who after a year doing the same thing week in, week out, don't know what they're talking about and don't know what they're doing. It's one of those repetitious things where you just learn it. And most people, in fact, there was one man in particular, he quite impressed me quite a bit actually. On day one, in fact, in the classroom, he absolutely was overwhelmed by what we were saying, because it was all brand new to him. Everything was brand new. And within 3 months, he sounded like he'd been doing it all his life. He just had the vocabulary down. He had the understanding. He knew what was going on. Now, obviously, we've been working with him and helping him. But the point is, after 3 months, he sounded like an expert. And that's basically what's available. Now, if you want to take advantage of this 9-day offer, it's only for 9 days, by the way. The normal price is $1,500. But if you want to go ahead with the one that's taken in 2 weeks' time, the number on that screen, make a note of it, please, because if you don't call that number, you can't get this offer. So, telling you straight up, don't call me, you call this number. If you call that number, then you can take advantage of that. If you don't call that number, that offer obviously in 2 weeks' time is gone, all right? Because the course is, that's a Friday, by the way. That's 2 Fridays from now, and the course on the Sunday. I'm going to open up the microphone for questions. If anyone's got any questions, now's a good time to ask. If you've got background noises, please mute yourself if you don't want to ask a question. Okay? So let me just unmute you. Okay.
1,000 people join TSB every day.
Okay, someone's got a TV on in the background. I'm not sure who that is. I can't tell who it is.
Hello everyone, my name is Nav. I'm an audiologist with Boots.
Has anyone got any questions for me?
You were saying about when
I'm sorry, who's speaking?
Linda.
Oh, hi, Linda.
You were saying about you don't have to wait like a month or a year to buy into the dividend. You could get it the day before or something, or on the day or something like that.
That's
right?
absolutely correct.
So how would you know when does a company send out information to say that they're going to give out dividends tomorrow? You know what I mean? How does one?
In other words, how do you know this? Let me tell you how I did it many moons ago. I actually had a diary.
Sure.
And whenever they announce it, so Reuters is the way they announce it to the world. Reuters is a news agency.
Yeah. Mm-hmm.
And essentially, I would get information from Reuters, put in my diary, and then I knew.
Okay.
So you can do that if you want to, or you can take a newsletter, and it's in a newsletter.
All right.
Now, but here's the advantage. No, seriously, because you could just go to Reuters. But here's the advantage of that. Reuters will not give you analysis and tell you how that company performed over the last 5 years. It won't tell you that. And in fact, to be honest with you, I don't want to blow big up Marcel investing offer too much. But what I will say to you is that we tell you this company has never rewarded investors in any time with it was decent in the last 5 years. So you would obviously leave that one alone. Now that information you're not going to get in the newspapers. It's not possible.
No, not at all. I thought maybe it was like at the end of the financial year or something, but clearly different companies have a different time that they release.
Let me tell you what the rules are.
Sure.
The stock market in England, by the way, it's different in other countries, right? But in England, most companies pay dividends twice a year. Most.
All right. Okay.
A tiny fraction pay once a year, and again another tiny fraction pay 4 times a year. All right, but most of them pay twice a year. That's the first thing. And the second thing, before you can pay a dividend, you must give 7 days notice to the stock exchange.
In the UK.
In the UK. So Tesco's needs to give a 7-day notice to the stock exchange that they're going to pay a dividend.
I see.
If they don't do that, they're not allowed to pay the dividend.
Right. So
that's number one. So you know at least 1 week before that they're going to do it. Now, most companies do it anywhere between 3 months and 1 week beforehand. They'll tell you.
So what happens if you leave your shares in the company?
Well, there's nothing wrong will happen, because obviously the share price, if you own the stock, sure, it's like owning a house, you know, you just own a house.
And sorry.
Go ahead, you go ahead.
I was going to say, and then can you, in the next fiscal or the next time that you pay, can you then purchase more stock or more dividends? Does that make sense?
Linda, can you ask the question again, please? I didn't quite catch that.
So say this year you purchased the dividends, you did the formula, you purchased a day before, and then next year, can you do the same thing? Can you just repeat yourself, or are you limited to a certain amount because you've already bought some?
The answer is you can repeat it any number of times you like.
As much as you can afford to do. If you want to.
Basically, wherever your fund is, you just do that. So let me tell you what we're doing, because we're actually doing something that is a loophole. And we're blunt with you. We're actually going through a loophole, and it's a legal loophole which works for us. So let me tell you what it is. What we do, we will let's say I'm going to take, say, £1,000 to keep the number simple.
Yeah.
I'll take £1,000 and I will buy some shares in say a company called WPP, which is the biggest advertising company in the world, right? I will buy shares in that company on, say, I don't know, middle of the week. And by the end of the week or the next week, I'm going to sell those shares. And I would have qualified for the dividend.
Okay.
With that, so let's say in this case, the dividend is 20%. So I started with 1,000, I've now got 1,200. Let's keep numbers really simple, okay? It's slightly more complicated than that, but I will show you in the training what we do. Because there's going to be some kind of, there's a formula to how we do it to keep safe.
Okay.
However, let's pretend we've got £1,000. We invest £1,000 in the fund. We've now got £1,200, right? Then next week, the money's available to do it again. So we don't leave the money in the company. Does that make sense?
Absolutely.
Yeah? So next week, when I get the money back, with my £1,200 in my account, I'm going to say, okay, fair enough. I'm now going to do the same again, and I'll do it with Barclays Bank. I'll do the same with Barclays Bank. Let's say Barclays takes 2 weeks to recover on the upside. So I come out 2 weeks later, and then in that week, I will take my returns, which is now been boosted by WPP and Barclays, and I'm now going to go and get in, say, Sainsbury's shares. Yeah. So what we're doing, we're only using our money to qualify for the dividend. Now, for those of you who are more technically minded, we're doing a bird dog strategy. So where this idea of the bird dog come from? This is where a guy would take a rifle and he would go shoot some pheasants or ducks in somewhere in the water, and then he would send his bird dog to go in the water to fetch the bird. Okay. This is known as the bird dog strategy. We take our money, we get the dividend, and we get back our money. We've got our dog, we shoot the bird, we tell the dog to go and get the bird, and we get back the bird and the dog, and we do it again. Does that make sense? It's known as the bird dog strategy. It's what we're doing. If for those of you who need to have a label on it, that's what we're doing.
So someone say.
Anyone? Are you okay, Lynn? Or
Yeah, I'm totally fine. I was just going to ask, on the Sunday classes, how long are the classes?
What we're going to do, I used to hire a college in Harrow, and basically we'd bring you there for the day in Harrow. But what we found is that me hiring the whole college for maybe 2 or 3 people didn't really make sense after a while. And so, and obviously nobody wants to be in a whole building, we just with a few people in there. So what I've decided to do is just teach online. And in truth, because we are investing online anyway, it is a much it's easier to do it, number one. And number two, you can be at home in your PJs and you're just watching me on the screen. Okay. Now just to let you know, it's not about you just listening to me, because you're going to be doing some exercises, because there are some skills I need to transfer to you. And so you're going to have to do the various things. So it's going to be like a class. So what we will do, we will have maybe a 1 hour session, take a break, and a 2 hour session, take a break, another session, take a break. And in total, we're going to be maybe online for about maybe 5 hours,
Okay.
5-6 hours online on the Sunday. So that Sunday, you got to block it out. Yeah.
And the weekly classes, how are they, about an hour, or are they longer?
And then after that, every Monday, we do a conference call. So the first part of the conference call will be like what we just saw today. And I'm going to be showing you what's coming up this week and the historical performance of those companies. And so which ones is more likely to reward you, if you're an investor. And sometimes all of them are rubbish. And we just say, you know what, forget about this week, because it's not going to be worth your while, because there's nothing going on. Sometimes that happens. And sometimes you've got absolute brilliant ones to go for. So what I'm going to say is every Monday we meet 8 until 9. and we do your regular newsletter analysis. And then between 9 o'clock and 10 o'clock, for new people, we do additional training. And this additional training carries on every single week until you are up to speed and don't need it anymore. And what we do is make sure you understand how to go onto the charts, how to open up, how to put money in your account, how to do everything, and all the safety rules that need to be in place. We show you all of that. Does that make sense?
Absolutely sense, yeah.
And we do that, and basically, I will do that until, but obviously because you're going to be there every single week anyway for a year, if you still need help 6 months later, it's all good. It doesn't matter, because I'm not going anywhere. This is what I do, so I'm more than happy to help you guys. But I'll be honest with you. I do have a slight agenda, and my agenda is to make sure that a lot of people from a specific community that I come from understand this. Now, I would just say this: there are a lot of people that, I'm not saying that other people, I wouldn't teach other people, because I will, but if you don't come from my community, it's fine. I don't mind. I'll teach you, because, knowledge is knowledge. But there are a bunch of people who, let's say, are familiar with something called rice and peas. Now, those people, I want this to be as familiar to them, and I want compounding to be as familiar to them as rice and peas is to them. Does that make sense? I want them to know this stuff. Now, we don't get taught at home, and we don't get taught this in school. And I want this to be something that we just know, and we want to be as familiar to us as rice and peas is to us. Does that make sense?
Absolutely.
And so that's my personal agenda. But like I said, I don't really care whether you come from, I don't know, another community. It's all good. It doesn't matter. Learning is learning, and skills are skills. Then these are all transferable skills. And what I would say to the rice and peas community is teach this to your children. Make them know this stuff.
Wonderful.
Yeah.
And the jollof rice community.
I'm sorry, say it again, please.
I said, and the jollof rice community.
And the jollof rice community. But you know who I'm talking about. Without me being,
Absolutely.
I mean, you guys know what I'm saying. You know what I'm saying.
Absolutely. I was just joking.
And so if you come from the fish and chips community, it's all good. I'm going to help you too. I'm going to help you.
All right, Miles, that's fantastic.
Yeah. Okay. Is there anybody else who has any more questions?
Hi, I'm Laura.
Hi, Laura.
Hi. I'm assuming there are charges involved. So what would you say the minimum investment amount should be?
Right. There is no real minimum. In fact, it depends on the platform you use. So some platforms say you must put in a minimum of $250.
Right.
Or some say 1,000. So let me just tell you what is reasonable. But you could literally start with. Remember we did a compounding earlier today.
Yes.
Okay. I'm just trying to demonstrate to you that with compounding, you can almost start with nothing. You can't really start with nothing, but almost nothing.
Mm-hmm.
So let me just give you another quick insight here. If you was to do the same thing and start with £1, how long will it take you to get to $1 million? Does anyone know?
Wow.
Apparently, a penny doubled.
No, not a penny, a pound.
I don't know.
Does anyone know?
No idea.
Right, let's go with the penny. I'm going to do the calculation right now. How much is the penny?
A penny doubled over 30 days is something like 5 million something. That's what I learned one time.
Well, I'm going to do the calculation right now. So you're saying 30 days, yeah?
Yeah.
Well, it's less than 30 days.
Yeah.
I'm going to say it's about 27. taking 1p. Now, by the way, you can't trade 1 pence, so let me not let me not go there. But I'm just doing the mathematical equation. 1p doubling over 27 periods, and even if you say 27 years, let's keep it realistic, it would become over £1 million. And so what I'm trying to say to you, really, seriously, this is going to be something that you must pass on. Now, believe it or not, this is actually in the Bible. What I'm telling you about compounding is in the Bible, and it's in the, for those of you who grew up as Christians, it will be the parable of the what was it now?
Talents.
Thank you. The parable of the talent. If you go to Matthew, the parable of talent describes exactly what I just showed you with compounding. So what I'm trying to say to you is that our ancient ancestors knew the power of this and taught them to tell us. It's there. It's there. This is ancient knowledge. I'm not telling something that I just made up yesterday. This has been known for forever. And the banking community have known this also forever. They use it. They use it. And I think it's Matthew 25. Read that and then go back to compounding and you'll see it. But let me tell you something that's really dark. Well, I won't say dark, but interesting. The person in the story who did not do this, he was called wicked for not doing this. So let me just, I'm going to take a stick and beat you guys now. If you don't compound your money, you are wicked. If you don't teach your children how to compound, you're wicked. And wicked people don't go to heaven. So your afterlife is in jeopardy. You're wicked. Okay, I'm only playing. But the point I'm trying to make, is that this is actually a fundamental. You must know this. You must. Yeah? And you can do it with anything. You could do it with property. You could do it with running your own business. You could do it with selling marbles. It doesn't make a difference. You could do it. But you must understand the formula and you must apply it. Don't just know it. And I think I was speaking to Linda earlier when I was saying, even though sometimes someone might tell you how to do something, that is not enough. You need to get rid of psychological blockers you may have so that you do it. You do what you know is right. Because a lot of people know something is right and don't do it. And that's something else. That's to do with psychology. And I'm going to say this to you, that there are a lot of people who come from, again, the Rice and Peace community. They have no idea that they're carrying trauma. They have absolutely no idea. There is trauma actually embedded in their DNA. And if you go with the idea of epigenetics and you understand what I'm talking about, it's there. There was a 400-year experience, and it's actually coded into the genes of those people. And I'm saying to those people, if they've got blockages, get some therapy. Because with the therapy and with the strategy, this becomes yours.
Absolutely.
Does that make sense?
Education, isn't it? It's about knowing yourself. This is Dion speaking, by the way.
Hi, Dion.
It's about knowing yourself.
Absolutely.
And your history, and then everything else should easier.
Yes, exactly. And sometimes you may not even know why you're struggling with some things. But I'm just saying, for those people who are struggling, even though they know what to do, they don't do it, get some therapy. Because therapy can actually unblock it. And once you unblock it, then you just set for your future generations to basically be freed up. And it's really important that you take steps. Now, unfortunately, it's only going to be those who care about learning and those who care about their families who will do it. But ultimately, that's who I'm talking to.
It has to start from somewhere, though.
It has to start. I know.
So,
I know.
Definitely.
Okay. Anybody else have any questions for me before we let you guys go?
Yeah, I've got a question, Miles. If you want to set up a program for yourself, if you had like a goal in mind, can you sort that out? Can you help with that sort of thing?
Give me an example of what you're speaking about, and I'll tell you if I can or not.
So, like, I know I've got 14 years left on my mortgage, and I'd like to pay that before that. So how would I be able to set a goal to ensure that is paid off well before that?
Okay. The answer is there are ways to do exactly what you're talking about. There are ways. Now, I'm not a financial advisor, so technically I can't advise you on that. All right. But however, let me just tell you this. There is 2 guys who wrote some books on this. One is called Alvin. I've got it in my library. Let me see if I can find it. There's an American financial advisor. His name is Alvin Hall. Alvin Hall speaks about this. He's an American guy. And there's also a guy called Rene. Oh, what's his name? A guy in England. Rene Carriol. Rene Carriol. He had a TV program in the UK. I'm sorry?
Spell his last name?
Carriol. I think it's spelled Caryall or AL. Carriol. Now, by the way, I don't. I'm only telling you about them, so I'm not recommending them, obviously, because I can't do that. But these 2 characters wrote books on the same subject you're speaking about.
Oh, okay.
Yeah. However, if you wanted to ask my opinion after this class, I could certainly just tell you what I think. All right. But remember, I'm not a financial advisor, so I can't go that route with you.
Right. Okay.
So if I did, it would be me telling you as a brethren more than me telling you as an advisor. Does it make sense? But then you've got to take responsibility to make sure that you do what is the right thing for you.
Yeah.
And also, I would say to you, you're absolutely correct. Get rid of that.
Get rid of it. Yes. Yeah. That's the. Yeah. I do definitely want
I mean, there is a strategy to it, but you don't want to have it beyond your retirement age. Do you know what I mean? You don't want those kind of problems.
Okay. All right. Thank you.
You're more than welcome. Anybody else have any questions for me? Okay. Based on a show of hands, is there anybody on here who would be interested in coming on in 2 weeks' time, getting trained up?
Yes, I would.
Who is that I would? Just let me know your name. So,
Dion.
Dion.
Again.
Okay. Dion. Do we actually? How did you come on this? How did you come on this?
Oh, via Angela. She's on as well.
Angela, how did you come on this?
Hi. Through you. I'm the team founder.
All right. Oh, excellent. Right, Angela and Dion, I'll take your numbers afterwards. So, Angela, Angela, do me a favor. Can you text me your number and Dion's number, please, to my phone afterwards? So I don't want to. This is a recording, so I don't want your details on the recording. And
okay.
Linda.
Yeah.
Can you text me via Jamie?
Okay.
So again, so that I know.
Sure.
Is there anybody else by show of hands interested in coming on the class on Sunday? Lovely. Okay. Now, for those of you who don't want to go forward, I want to thank you very much for attending, and I really hope that what you heard today was useful for you, because I do want to leave you with something that you can actually take away and actually do something with. So, for those of you who don't want to go forward, is there something that would be useful to know now, before we part company, that you could use later on? Is there any questions that you have that around this whole area of compounding or the whole area of just investing? But remember, I can't really give you specific advice, but is there anything I could actually help you with before I let you guys go?
I'm just thinking out loud, Miles. Do you have any testimonial from your other students that who are in our position, so that we could hear from them?
Well, I believe there might be one person on the call right now. iPhone 7. Would you be happy to talk?
Have they gone to sleep?
And they muted their phone. Let's have a look. Well, maybe they're being shy.
I'm here.
Oh, okay. iPhone 7. Would you like to say what your experience is?
Okay, so I've been part of the Milestone Group for, I think, about just over 2 years. And I started off originally with one fund, and then I got quite good at it. So then I started working on 3 platforms using 3 different funds. And they had slightly different strategies. So one of my funds was I would compound 50% of the fund and take out 50% of the fund and put that in the bank. The other one was a straight income fund. So I had a base amount, and everything I earned, I cream off the top and put in my account and use that money as an income. And then the third one was just purely compounding, so I didn't touch it at all. Now I just have the one fund. So what I did is the strategy there was I traded those 3 funds for about 9-10 months, something like that. And I was able to, the one where I was half compounding, I was able to just over double that one. The one where that I was using as an income fund, that earned about, in that 9 months, that earned about something like 15-20%. And the other one where I didn't touch it at all and I compounded, which was the most impressive, I was able to make 5 times the actual fund within those 8-9 months. So it's really important to compound, especially if you don't want to use it as an income. So if you're not using it to swap your jobs, then it's really important to compound so that you do have that large sum at the end that you can then do whatever it is you want to do with, retire, have it as a retirement fund, or buy houses, or whatever it is you want to do with it. But yes, I've found it to be very successful. It's fairly safe. You do have weeks when you can't trade because there isn't an opportunity that is more than 20%. But if you follow all the rules, you just slowly keep compounding once a week, each week. And it's it becomes very enjoyable. It's scary at first, but then it becomes quite enjoyable and quite exciting when you start to get into the really big numbers. And it doesn't take long to get to those big numbers.
How long did it take you to get used to the trading? Oh, sorry, is it trading?
I'm quite a quick learner, so I would say about just over a week.
Oh wow! Okay. Thank you.
Yeah, I was quite quick. After I did the course, I think I traded the following day. I think, yeah, I'm pretty sure I did. Yeah, the following day, I was ready to go.
Okay. And were you working full time whilst you were?
No, I've not worked for quite some time because in the 90s I bought property, so I didn't need to actually work full time anymore.
Oh, okay.
Anybody else got any questions before I let you guys go? Everyone happy?
Very.
Thank you
Okay.
very much. Thank you so much.
No, you're more than welcome. You're more than welcome. Well, I want to wish you all a very, very pleasant evening. And for those of you who are interested, pass on your details and we'll get you all signed up for 2 weeks' time. And for everybody else, well, I wish you all the best. Yeah, and hopefully today's gave you some insights into going forward. But let me just quickly summarize again. Number one, compounding. You absolutely must have that under your belt. Compounding, and use it for your benefit and not against you. The banks use it, so you can use it too. And secondly, if you come from what I'm going to call the rice and peas community, and a lot of us have to get over some stuff that's where we're carrying basically intergenerational trauma, and because it's important that you get your mindset right, I'm going to suggest that maybe you get some therapy to handle it, so you therefore you don't end up sabotaging and blocking yourself. Okay. And that's really it. And I want to wish you all the very best and the most success. Take care, guys.
Thank you.
You're more than welcome. All right, you take care. Bye now. Bye now.
Bye.
Bye-bye.